agent and the broker, yeah. Move over, we getting bolder, making moves like the agent and the broker, yeah. Generational wealth, they bout that. Yeah, we took some L's, but we bounced back. Financial literacy, got that. Closing up the wealth gap, yeah, I'm black. Welcome to the Agent and Broker Podcast, hosted by Julian and James. And you know they bringing nothing but that black boss talk, man. Cause there's no currency stronger than the black dollar. And it's time we let the world know. But first we gotta grow though, and that's for sure.
What's up, family? How y'all doing? James, what's going on?
Man, I'm good, brother. How are you? How's everybody out there doing?
Man, I am good, man. Blessed, brother. Good to be here another night. And welcome y'all to another episode of the Agent and Broker Podcast. I am your co-host, Julian the Agent, license W626089.
And I am James Denizier, license number W282336, repping Florida all day, every day.
Every day. All right, baby. Yes, sir. So James, we added another week, man. We down another episode, man. We're like around 24, 25. No, I think 25, episode 25, man. And we're gaining some traction, bro. Like we're getting some, we're creeping up almost 400 downloads so far on over there on all of the platforms. So iTunes, Google, Spotify. So thank y'all for tuning in. Give us feedback, y'all. If let us know what you want to hear, what you think we could do better at. Like we want to give this information out, and we like giving it out. So we appreciate y'all for tuning in always.
Yes, sir. Yes, sir. Appreciate all the downloads once again. That means we have people who appreciate what we're doing out there. Just make sure you share it. It means the world to us when you download it because it helped the show grow. That's one. And like Julian said, when you give us some feedback where there are certain things you would like for us to talk about, that's even better because now we know that we're interacting with you and, we're covering exactly some key points on what, you want to listen to. Even I was actually listening to it in my car, Julian. I don't like listening to myself back, but I was driving to my office and I'm listening to the episode. I'm like, oh, man.
Yeah. That's how I feel sometimes. But sometimes when I'm working out, I would listen to it just to see, okay, well, this is where I could have done better, or I could have said that a little bit better, or I could have did this. All right, that one was cool. So, just for better performance, that's when I listen to it. But sometimes I don't like listening to it either, bro.
So you listen to your own voice back, yeah.
It's very, very weird listening to yourself and hearing your own voice. But it is exciting, man, to even be doing this and to continue doing it and growing it. And, we got some big things going with this agency and, in general, the agent and broker is getting bigger than we even, kind of what we thought it would be. And, we're growing and changing the direction and pivoting when we can, but things are, opening up for us. Doors are opening and, this information needs to be out there. And, it's exciting to even get into the community, get into the school system and, allow the community to work with us and grow this platform, bro. That's what it was really, really for, to be honest.
Exactly, man. And I'm just thinking of myself right now. I just wish that I was wise enough at a young age, at 18 years old, and being exposed to this information. I wish, so us being able to actually get to the schools and we are extremely welcome. The when we covering some of the topic with the kids and even the teachers, they're so excited. They never hear of anything like that. And Julian, I know. Hey, listen, I know I put in a post earlier. Bro, we might as well call ourselves the king of insurance, man, king of life insurance in our community. because ain't nobody doing this locally like we doing it. Coming out,
Uh,
going out there grinding,
yeah,
having a podcast,
right,
through
right.
some free gems, and having
Mhm.
guest speaker coming to the podcast, uh, you know, from different industry. But bro, I think like down here and locally,
Mhm.
Eatonville, Orlando, bro, I claim king of insurance, man. I don't care who
Absolutely.
else out there,
For sure. No, for
Yes,
real.
sir.
Like, you want to know about life insurance, even you're gonna tune into this podcast or you're gonna come to our page, man. We're educating you, and we're hitting you like throughout the day, and it's no game. Like, you getting a post in the morning when you wake up, you getting a post in the afternoon to digest some information, then you getting a post in the evening as well. And just wait, y'all. It's probably gonna be more posts. Like,
Oh yeah.
talking about 5 to 6, 7 posts a day, even posts going on at nighttime as we continue to build and grow. But thanks to our intern who's been doing a phenomenal job, Josiah, and
Mhm.
what he's been able to do. And then our also some of the think doors are opening and we're able to now put extra money to help us grow this platform and grow our insurance business. So that was the goal with this platform, was to grow the insurance agency and possibly employ and then also license other agents to bring them on and build. So guys, if you are interested in becoming an insurance agent and learning different things about the industry, you consider any sector in it, man. There's so many different avenues to run in it,
Yep.
so many ways to grow in it, and it's a beautiful industry to help other people. So it is a honor, bro, really. And I didn't see this coming 2 years ago when we first met, but it's coming together, bro.
Yeah, absolutely, man.
Coming
When we met, I thought of that yesterday. I'm like, man, when we met, I never thought we would be working on something like that.
right.
Never, not in a million years, right?
Nah.
But I'm so thankful we start this, and I'm so thankful that the king of insurance. That's right, Ruthie. I'm so thankful we are going down this path because it's
Oh
so
yeah.
valuable. And one of the things that I'm extremely appreciative of is the vision that from the get go you had, way before we started the podcast, but to actually the vision to actually get to the kids. Remember, we went to one of these high school.
Hmm.
This lady was giving us the runaround. We just wanted to
Right.
teach financial literacy,
Right.
but it's just all about get them young, start them young,
Yep.
make sure the eyes are open to great opportunities. It's not just about college or military, because that's the only two options
Hmm.
most kids have out of high school. But what
100.
about some financial literacy? What about entrepreneurship? So
Right.
nobody's really out there, or not enough of us are really out there, trying to get those kids as early as possible to teach them, hey, there
Mhm.
are many options for you to be an entrepreneur. So it's not just college, or it's not just military. There's a
Yep.
lot of opportunity out there. So I'm very thankful that we go that route, man. So
100%. Same
yes,
here, bro.
sir.
It's been great. So
Mm-hmm.
I look forward to the future. And anybody wanting to, join, again, you can DM us, or you can also leave a message on theagentandbroker.com. Hit us up. Let us know if you want to get licensed, man. It's not expensive at all. And we, when it comes to the business, we're not sitting here. We're not going to beg you to do one thing or this, like that, or recruit or do all of this. If you want to recruit, you can recruit. If you want to write business, you can write business. The beauty of it is you own your book of business from day one when you come start with us. And anybody in the insurance industry knows, if they've been in a little long enough, they know what I mean by that. You own your book of business. And some companies, you don't always own your book of business, even though they tell you that. But when you work with us, you're truly independent and you can run your agency and grow your business how you want to grow it. So if you want to run a small business, you can. If you want to run a large agency, you can. So it really is on you. It works if you work. So you
Straight
know
up.
we got a lot of good things coming, man. A lot of a big money coming too. So I'm looking forward to it, man. But tonight we are going in depth, man, and we're going into this beautiful product. Our it's like the magic product. We always promote it, man. We always say it's like the dang fix for everything, you know. But this is the IUL, the Index Universal Life Insurance Policy, man. And we're gonna dig into it. We're gonna cover some questions, some debunk some myths, you know, things that you probably see floating around online, or just questions that people may have and questions you may see online about these policies. So we got some questions that we dug up, and feel free if you do have any questions that you want to know about the policy. Definitely leave a comment, whether that is on YouTube or if that is on Facebook. If you're on live right now, leave a comment and reach out to us if you have any other questions.
Absolutely, absolutely. We're more than happy to answer any questions you may have, because that's why we're here. And it's funny, man. It's like I text this guy today. It's been like a few months since we spoke. I just text him just to follow up on him, and he was like, "Hey, man, I just been watching your show. It's pretty nice what you guys are doing out there." And in my head, I'm like, "Well, you never asked any question, and you never, So listen, man, just ask question, because the questions you ask is actually going to help somebody else.
Absolutely.
So even though you listen and maybe know the answer, or you somewhat knows the answer, but somebody else who's listening, they probably have no idea, and you're gonna help them out. And we're very blunt. We don't know everything. We don't know everything. And
Right.
honestly, if you ask us a question we don't know, we'll make the research for you, and we'll find out, and we give you the information. So we look forward for everybody to communicate and ask questions, whatever you want us to go over. So yeah.
For sure, man. Yep. So we are here. We're going to dive into it, y'all. So some of the questions we have. So our first question on the list is, what is an IUL? What is this infamous IUL? What is this taboo product that everybody is talking about on the market right now? And you probably see it. You can hear people from negative to positive things about it, from Dave Ramsey to the Dave Ramsey crowd, to all the way to the Doug Andrew, to Waka Flocka talking about it. All of these different things, it's all mainstream now. So life insurance is becoming a mainstream product. So what is IUL? Index Universal Life. If you're listening to that, write that down if you don't know what it is. Indexed Universal Life. That's what the acronym IUL stands for. And that is a type of permanent life insurance policy wherein you're credited interest to your cash value component, and is linked to the market of an index such as the S&P 500. Or to make it more simple, it's a type of life insurance policy that provides a death benefit and also cash value component for you while you're living. So you get the benefits of death benefits and living benefits within the policy of an insurance contract. So I hope that was, as simple and clear as possible, honestly. Like, I gave kind of a one that some may not understand. I made it easy as well. So anything else you wanted to add on there? What is an IUL, James?
To me, I'll just give my opinion. An IUL is a no-brainer. Exactly what it is.
Absolutely.
The definition is very clear. It's straight to the point. It is a life insurance product with a component of having your money grow. And when your money grow, it grows tax-free when you take that money out, as long as you know exactly how to take money out of it. But it's just a beautiful product. And like you said earlier, there are pros, there are cons. And even though there are cons, I haven't seen anything that really beats the IUL, to tell you the truth, out there. But yeah, the definition is straight to the point. Straight to the point, man.
Seriously. And when it comes to things beating it, like you just mentioned, man, it's far too few products, if any, out there that can beat it if it's done correctly, y'all. We want to make sure that we touch on that point, because you'll have people debate you. You'll have people who do whole life debate, try to debate you. I don't even debate with people about this anymore. That's how much I don't care to debate, because I know what the product can do. And I go to trainings, I get special trainings for this, and I know what this product can do and how it can perform, to where, okay, no whole life advisor or insurance person can really like debate me or try to even sell it to me, a whole life policy, which is cool. Like, whole life is cool. I'm not knocking whole life or anything, but when it comes to me and where I am in my life, I like IUL. I like universal life a bit better. So that product, man, it really is like it's that Swiss Army knife for, you know, or for financial, like that financial Swiss Army knife where you have everything in one. So it does everything that a Roth IRA does, but with the benefits of life insurance, the benefits of having that access to your death benefit if something happens, whether you get sick, like terminal illness, critical illness, like cancer, heart attack, stroke. You have access to money while you do that, and you don't have any strings attached to this as well, unlike a qualified account like a IRA, a Roth IRA or anything. But
That's correct.
so how does the IUL work, James? You want to take that one?
Well, the IUL work, and to tell you the truth, whatever, well, I don't want to say whatever. Most plan people have financially, an IUL could actually solve it.
Mm-hmm.
So based on your needs, then you can structure the IUL. So are you looking for distribution within the next 3 years? Are you looking for the IUL to pay you within the next 24 months? Or is it the next 10 years? You know, so how the IUL work is all depend on the person outcome. So for example, earlier I was talking to Julian about a case I'm working on with somebody in Texas. So guy, he's actually putting about 25 to 35,000 every year on that IUL, right? But the reason he wants to do that is because he heard of some people talking about how he can use that for tax purposes. So when we met, we did a virtual meeting, and come to find out, this guy, he used to pay about $80,000 in taxes, right?
Mm-hmm.
But now he found a really good guy, a guy I know very well. Now he does his taxes, and his taxes decreased. So what is he looking to do? Well, he's looking to use that same money twice. So instead of writing the check to the IRS directly, he can literally write the check to the IUL, and then from the IUL write it to the IRS. So somebody would say, well, why do this extra step? Well, that extra step is a life-changing step.
Oh yeah.
It's very simple, a life-changing step. So if every year he put that $25,000 into the IUL before he paid the IRS, literally not only he's gonna pay the IRS, but he's putting $25,000 into a cash value index universal life insurance. It's crazy. So which means that same $25,000, he's a young man, 31 years old, give him over $1 million in death benefits, living benefits. And the way we structure it, by the age of 65, he'll have access to $130,000 tax-free income. All that is just by actually adding one step to the financial situation. Mm-hmm. Don't just write a check to the IRS, because once you do, you never see that money again. Where does that money go? You go straight to the IRS. You can't use it. You can't call them and say, hey, can you send me 10,000 back? Because no, it don't work. But if you run it to an IUL and then pay them, it's a whole different ball game right there. Now it's just infinite banking in a whole nother level.
Right.
So you use that same $25,000 to pay the IRS, and that same $25,000 you're still putting it into the IUL, accumulating cash value. So to really answer your question again, the IUL can be used for whatever financial goal someone has. As long as you're sitting with an individual who know how to structure it properly, the correct way, man, it's just such a powerful tool.
100%. And to add on to that, man, that was a good example. Like you mentioned that he puts 25 in here in this account before paying the IRS. The reason why you would want to put that there is literally using the same dollar twice, y'all.
Yep.
You're going to put 25K inside the insurance policy. And what happens is your money is still linked inside of that policy. And you're going to ask to borrow, the money again, borrow the money to pay the IRS. Now you're borrowing the money. It's still in the policy working for you. So you now have money working for you, and then you're borrowing it at a interest rate. Let's say hypothetically, you take out an index loan at 5%. Let's say the market does 8 to 9% that year. Your loan will wash away with the money that's in the policy, because you're going to get credited 9%. Remember, you took out a loan at 5%. That's 400% more than what your loan was. Your loan gets washed away from the credit from the insurance company. And this may go over a lot of people's heads, but this is a very, very like advanced method of finance. Finance is really in out there, man. A lot of people don't know about it, but it's literally using the same dollar twice and gaining interest on your money. So you're making money for spending money, if that makes sense. So the IUL literally works by any way you need it to work. It also can work for retirement savings, y'all. So how the IUL works is really like plans for a tax-free retirement. So people utilize it, they fund it while they're young, or a lot of people, what they do is they funnel their 401ks, IRAs when they turn 60, 59 and a half, 60 years old. And what they do is they funnel the money into the IUL as fast as they can and with the most amount of money as possible. So whether their 401k is at $1 million, $2 million, they're going to try to funnel in $500 to $1 million into that policy. Why? Because you're going to get the taxes over and done with on that 401k as early as possible. Second reason is that money's going to start growing tax-free now that you got the taxes over and done with. And then you will, like James mentioned, you will get a tax-free income for the rest of your life. So like he mentioned, the brother got, what was it, $130,000?
$130,000 tax-free lifetime income.
Lifetime income. So that's $130,000 guaranteed in his pocket till the day he dies, even if he lives to 120 years old. So the insurance company is guaranteeing to pay you out this much money if you fund the policy like this. So y'all name me any other financial vehicle that does that, because I haven't seen any on the market in my years of being in this industry. Honestly, I haven't seen anything like it. So the IUL is like a vehicle that can be used for infinite banking. It's a vehicle that can be used for tax-free retirement. It can be used for any type of financial planning or that you have going on in your life, whether you go through a rough time or anything, you have access to that money. So that's pretty much how it works, man. And James made a great example. So
and also just to cover an extra thing, Julian, when I speak with people, when they're looking at their portfolio, they're so proud, they're so happy to have an account that is tax deferred. To them, that's the best thing that's out there. Yeah. If somebody, I mean, there's three ways people pay taxes. You pay tax now, you pay tax deferred, or no tax. Okay. So on these accounts, when we say it's tax free, it's really tax free, because really the normal way is when you gain compound interest into an account, that interest you gain, you're supposed to pay taxes on it. Capital gain, that's what it's called. So if you're buying stocks, mutual funds, bonds, and you get your capital gain, yeah, you're making money. But guess what? That money you make, you have to pay what's called capital gain. Yeah. Which Biden, man, this administration, not to get too political as well, but when it comes to capital gain, man, they tax the heck out of you. Oh yeah, like it's crazy. Yeah, man. So what to keep in mind is tax deferred, like this 401k. Everybody know what the 401k, that's tax deferred, meaning that you're gonna pay taxes later. But as we can see, taxes are going up every year. Inflation goes up every year. So when you think you have $1 million in your 401k at retirement, no. You're gonna pay a whole bunch of taxes on that. Right. So $1 million become maybe $600,000. You know, so when somebody say tax free, that's a huge component when it comes to retirement. And I know people probably like, man, I'm in my 20s, I'm in my 30s, I don't really care about retirement right now. I'm gonna tell you straight up, you're a fool. Like I was the same way. I was a fool. Like I'm like, man, don't talk to me about this thing. But when I find out exactly how powerful these things are, let me tell you, man, don't be ignorant behind these things, because it just don't make no sense. You're not thinking about the future, you're just thinking about now. Yeah. Because when you get hit with those taxes, or you get hit with inflation, or let me tell you, man, tax free is the way to go.
The more you procrastinate, the worse it gets, man. Like if you're 20, 5 and you say, I don't want to think about retirement, and you wait 10 years, if you wait 10 years and you didn't put away at least $150, $200 a month inside of a interest bearing account, like you literally losing pretty much like maybe 300 to $400,000 or $500,000 in
Yeah.
savings just off of 10 years. And I hear a lot of people that, you know, we meet with, or people just in general, like, I don't want to think about that right now. I don't want to think about retirement. I don't want to think about life insurance. And this is literally a tool that you can use every day if you needed it. Honestly, if you're an entrepreneur, you can use this tool to hold your sitting capital. You can use it to prepare for a down payment for a house, bro. Like, you can use it to invest in anything, and you can utilize the insurance company's money. But you know, we ain't gonna get too much into that because we want to get through all of these questions. But and speaking of like the tax-free things like that, like when it comes to not paying taxes, and when it comes to tax-free, we want to ask, like, well, a question here is, how is that IUL tax-free? And the IUL, literally, it is tax-free. I'm going to share this real quick. Based off of the Internal Revenue Code, it's the only financial instrument in the Internal Revenue Code that allows these three things. And that's life insurance. It's the only financial vehicle, again, in the Internal Revenue Code that allows you to grow your money tax-free, which is in Section 72E. And then you can access your money tax-free, which is Section 7702. And then Section 101A is it can blossom and transfer to your transfer tax-free to your beneficiaries. So meaning that your money is going to grow tax-free in that policy. So if you fund your policy, the insurance company is going to credit you money, and on a yearly basis, monthly or yearly, however you want to do it, and they're going to allow that to be tax-free. So it's going to be after you pay your taxes. So you get paid from your job, boom, you pay your taxes and everything. Now you fund your policy, so it doesn't get pulled right out right away, but you fund it outside of paying your taxes. Then you fund this policy, and that's when you get the interest again. And then where we say you can access the money tax-free, the government pretty much said, like, okay, well, since this is in life insurance, we're going to allow you to borrow. Since we can't, for it to be tax-free, we're going to call it a loan. So a loan, a lot of people think of loans, they think of negative automatically. It's a loan. Like, why would I want to get a loan? Why would I borrow my own money? And that's what people are saying. However, what the wealthy does is they utilize loans to avoid paying taxes.
Yep.
Guys, if you look at taxes right now, like the rates are going up, and I don't think they're going to go down anytime sooner. Like, the way we're going, like whether that's inflation and taxes, is not going back down. So what the wealthy does is they utilize other people's money, and that's all this policy allows you to do, is utilize other people's money. But if you have a policy, I've seen insurance professionals sell people a permanent policy, whether it's whole life or a universal life, and the person withdrew the money instead of taking a loan out because they weren't educated on the portion of getting a loan from the policy. And that is the tax-free benefit of this policy, is getting that loan. So to educate you guys a little bit on that, on if you withdraw from the policy compared to you know borrowing from it, when you withdraw from the policy, you pretty much take out the money, and then you can be taxed on that money if it gained any interest. So which most likely is going to gain interest, you're going to get taxed on that money, and is no longer in your policy. So you pretty much almost forfeited your policy, and you didn't understand why, because you weren't educated by an agent that knew what they were doing.
Yep.
Anytime you want to take out money, you have to check that box, borrowing or a loan. I want a loan from my policy, because now when you get a loan, you use the insurance company's money to you use their money to utilize it, while your money stays in the policy and works for you. That's how it is tax free. The IUL also provides that income tax free. So you get that retirement income whenever you turn 65, 60, 60, 65. Some people could set their policies up. If you make a lot of money, like millions of dollars, you could set it up to where you are 40 or something and you get money to the time you die. Like if you have that amount of money, you can fund it that way. So they call it the rich man's Roth for a reason.
For sure. And to do a little piggyback right on the borrowing as well, understand, and it's a pretty unique concept. Why would I borrow my money? Well, like Julian say, that's the only way you can actually have tax-free income. Now, some people say, when I say, well, that loan, you don't have to pay it back if you don't want to. Well, what do you mean I don't have to pay back if I don't want to? So this is how it's set up. The life insurance company use your death benefits as a collateral to that loan. Okay. So say you have $500,000 and then you take a loan out for 80,000, and I'm just going to keep it as simple as possible.
It's perfect for you right there.
Oh, there you go. So say you have that $500,000 policy and you take out 80,000 maybe to do whatever you need to do to your business. Maybe you get into a business venture. Maybe you take that money out to put down in a house. Maybe whatever it is. Maybe your kids are going to college. You need that 80 grand. It's fine. When you take it out, you're using the insurance money, not yours. So which means whatever you have in your cash value, it's not touched even though you take that 80 grand out. You're still getting the compound interest like constantly on that same amount. So what the insurance company say is, well, John, we have enough money in reserve, and listen, we know you're gonna die one day, maybe 120 years old if you're lucky. So it's okay, we can wait. Because what we're gonna do is, if you decide not to pay that loan while you're alive, we're only gonna deduct that 80,000 from the $500,000 death benefits and provide your family with the 420,000.
Right.
Is that simple? So when you're borrowing, to me, it's like, why not? Why not? It's crazy. So that's what you must understand. The life insurance is not going to lose money. Somebody's told me, well, then doesn't that mean they're losing money? No. If you understand the strategy, and I know earlier we talked about whole life, and then compared to the universal life insurance, I'm pro IULs, Julian pro IUL. But this is why we're the kings of insurance, man. We're not gonna fight you if you want to take a whole life. We'll structure that for you, and you're gonna receive your dividends because it is what it is. But this is why this is one key component you must understand, and Julian was gonna touch on it as well. Is whenever you're structuring an IUL, you must understand that the person who's structuring it for you, must know exactly what they're doing, because not a lot of agents know how to set that baby up, because they can mess up your gain. And we just cover that a little bit, later on. But you have to make sure the person know what they're doing before you set up an IUL for sure.
Absolutely, for sure. Like, you can get really messed up, y'all. Like really
big time.
Like it's been a disaster, and it's a part of the reason why you can Google IULs and you'll see a negative, a negative, perspective connotation on them. You'll see negative articles, and that's because a lot of people don't know how to structure them properly. And there's a way, and I hate kind of like doing, talking about the insurance industry, but it's the truth. The truth has to be told, like, because people can easily get on a Google search of IUL and see a bunch of negative things about it. And they'll see videos on why not to buy IUL. And those are literally from people who sell whole life, people who sell term. Dave Ramsey, who is against permanent insurance, but probably has permanent insurance. But
yeah, probably.
That stuff, that education on the negative side of it is coming from people who are against it, people who their investing strategies are a bit different, so they have to utilize attack the vehicle in a certain way. But what happened was, a little story behind it, Early in the 2000s, insurance agents were improper. They were incorrectly structuring IULs, and they were selling it at high projections for people, and then when what happened was they structured it improperly and it didn't perform how they projected it. So what the insurance industry did was they put a protocol on all companies to have to put a certain type of illustration rate inside of these policies. So now you have a illustration rate, whether that is 5 or 6%, that the agent has to show you, like, okay, well, if the policy performs here, if the market goes up, you're going to get a hypothetical of 5-6%. That's pretty much standard there, and that's kind of like how it got that way, and it's just because improper structuring. But not to get too caught up on that, our next question is how how do I get 7 to 8% on my money if my money is not in the market? So James, you could take that one.
So how you get 7 to 8% when your money is not in the market? So it's because the policy is being credited. Okay, as you making the premium, the policy is being credited. Do you have that on the screen, Julian, so I can actually touch it point by point? So when you have your IUL, the IUL depend on how you structured up for the allocation, because that's another great key component right there. How you allocate the policy and to target which market. Okay, so the insurance company, they actually cap. When you have an IUL, you actually cap at a certain rate. So when there is a gain in the market, say your cap rate is at 11%, 14%. When there is a gain above 14%, you cap at that 14%. But it all depends on how you structure that IUL as well.
Absolutely.
Yeah. So I don't want to get into too much detail, so I don't confuse people. But it looks much better when we sit with you as financial professional, explaining to you the product, and we bring out a screen based on your numbers and what is it we're solving for. And from there, you look at the illustration, and the illustration show you the worst case scenario and the best case scenario. Right. Now, the way IUL set up, these scenarios, even the best scenario is actually kind of like under promise, over deliver, because most of these products illustrated at less than 6%. Most of them, you might see a 6.2, 6.5 every now and then, but really you're looking at an average of 7 to 8%. 100. So which mean if the market continue to do exactly what it needs to do, then your potential gain is even greater. So that's why they show you a lower illustration. But like I said, when we sit with you as financial professionals, financial strategists, and showing you those numbers in the illustration, then you'll make a visual sense on exactly how your account get credited.
For sure. It's beautiful, man. You get the crediting strategy, and something to add on to that too, on how your money's, you're getting interest, but it's not in the market. So if a lot of people don't know, the insurance companies they have some of the best option traders out there in the game. Like, they're the strongest financial institutions in the world.
Backbone of the industry.
They're the backbone of the financial services industry. They've been around for 300 plus years, and there's a reason why very few of them have gone bankrupt. So they invest in very conservative bonds, gaining about like 5%, honestly. And this is what majority of them do. So if they're getting 5%, now you add on what James just said, the interest crediting strategies. So now you're getting up to 8, 9, 10. Sometimes some companies go up to 14%. So if you're getting that much on a policy, but they're getting you 5% in bonds, like, this is how they're able to give you money or credit you this money without having to invest it for you in the market. They're going to do the investing. They're the grade A, the master investors, the insurance companies. They've been doing it for years. Again, they know how to trade. They know how to invest in skyscrapers. Like, I was in Boston And what did I see? I seen a big tower. The biggest tower down there is pretty much the Prudential Tower, bro. Like Prudential is one of the largest life insurance companies out there. But you know, they invest in the commercial real estate like that, and they invest into it at a very, very low minimum risk on their end. So just how you can go and get a mortgage from a bank at about 80% or 90% and loan the value, and you only have to put down 10%. Insurance companies come in at about 50%. So it's like 50-50. They take on very minimal risk when it comes to these skyscrapers. So this is how they are able to give, you know, their customers money. Is like, hey, you give us your money, we're going to invest it for you. So it's not an investment vehicle, but they are, you know, doing their part and giving you the bonds and then the crediting strategies to that. So that is how,
Absolutely.
yeah, that's how they make them, how you get your money, your 7, 8, 9, 10% on that money every single year. So the next question was, what are the guarantees in the IUL? So some of the guarantees, I'm gonna take this one. They can be, if you look at an illustration, most illustrations always has a guarantee section in it. One, it is to show you what is this guarantee going to be if all fails in this policy. So most guarantees are around like 2 to 3%. If the market does not form, if it does not perform, and you're around 2 to 3% in interest every year, this is what you're guaranteed in your policy. And if the policy is not structured properly or correctly, you have in that policy what is called a cost of insurance, COI. If your cost of insurance is extremely high, and the reason why it will be high is because your death benefit is high. So the goal of this is to decrease your death benefit as much as the IRS will allow you. And then you want to make sure that your policy has the cheapest amount of insurance in it during those times, because if something happens, say the market doesn't perform in 5 years, like we had a downturn where we had negative impact all 5 years, you want your cost of insurance to be extremely low, because if it is high, those fees will eat out your cash value, if you get what I'm saying. Because if you're only going to get 2 to 3% on that policy, then you're not gaining any money pretty much, and inflation is higher than 2 to 3%. We know that. But if you're only getting 2 to 3% on your gains and your cost of insurance is extremely high, all that's going to do is eat out your fees, and you're not going to be getting any money. If anything, in 10 years, you have a lapsed policy. So this is how, you know, you get those. This is how the guarantees work in that policy. And every insurance agent will show you those guaranteed values when they do an illustration for you, because it comes with the policy. It shows you this is what you get guaranteed if all fails, which barely ever happens. It's never happened. So I don't think that will happen, where we're going to have a straight 20-30 year drought. But, you know, if there's anything else you wanted to put in there, James, go ahead.
No, I think you hit it right on the nail. You know, your cost of insurance. That's why, like you said, the foundation is to structure that baby the right way.
Yeah.
You know, and when you look at the history of the market, you never have like a 15-20 years fall. Like, you know, it doesn't exist. And that key component with the cost of insurance, a lot of people who's really you know, against the IUL, a lot of them actually, that's where they see that, you know, they sit right there in the cost of insurance. But really it's not really a huge factor, considering what the market has been doing for the past 20, 25, 30 years.
Right.
You know, but no, I think you cover everything, you know, exactly how it is. When you look at an illustration, make sure you look at the guarantee and you look at the current market. And the current market typically is what really the most accurate when you're looking at an illustration of an IUL.
Right. 100%. For sure. All right. Let's go to the next question, y'all. The next question on here is, what are the max contributions in an IUL? So what is the most money that you can put into an IUL on a yearly basis?
Well, the most money you can put in, it all depends on how much money you want to put in, because unlike some of the accounts where you can put more than 6,000, so it all depend on what you can start the account with. And of course there is something called a MEC. Once you start the account, you're gonna have what's called a MEC number. Say this MEC is $65,000. MEC pretty much mean if you go above that $65,000, then you're going to actually have to pay taxes. So which one of the main reason people open these accounts is to avoid paying taxes, so the maximum contribution is based on the amount you start. So in your illustration, say you start at $25,000-$30,000, that's going to be your yearly contribution. But it is flexible. Flexible meaning there is a lowest point you can pay for that policy, and there is a highest point you can pay for that policy. So it's that's what I would say on that one, Julian.
For sure. That's good. And honestly, like that's a big gem there. From the highest to the lowest to the highest amount you can put into that policy, because contribution wise, some people is like, okay, I want to start at, let's say $200, $300 a month here. But let's say in 5 years to 6 years, you started your policy and it's at $300 a month. But in 5 to 6 years, let's say you created a business and it took off and now you're making 6 figures, 7 figures. And some people like, well, what do I do? A simple way, you create another IUL. You can have as many buckets as you want. Like there's no limit on how many IUL buckets. And when I say bucket, how many IUL policies that you can have. So if you get another lump sum of money and you're making a lot of money, create a new bucket. Use that first one for long-term cash value retirement, or utilize it for something else. You can always create that new one to specifically, cater it to something that you need. So if you want it for sitting capital, you can just create a new one now at a higher limit. So if you're able to put $50,000 to $100,000 inside that policy, you will be able to do it by just creating that new bucket. So that's a simple way. Like if you do come up on the money, like it's flexible, like James said. If you did structure it a certain way, like early, then you'll have that room already in that policy. But if not, just create a new one. It won't hurt you. Like keep that first one, but create that new one as well.
Just hopefully by the time you create a new one, you're still in good health.
Absolutely.
You're not sick or anything, because at the end of the day, it is a life insurance product. You do have to qualify before you can actually start putting money on there. So I'd encourage people, if you hear that thing, you hear about the IUL a lot, maybe it's through us, maybe it's through other people, and you're thinking about opening one, better you open one ASAP, and then you figure out if like, okay, you know what, maybe I can put more, or maybe I can open another one, than for you not to take action right now. Because the moment something happened to your health, the moment you go to the doctor and they see something funny, like you just increase your chance of not qualifying for you to get an IUL. So that whole waiting game, man, especially when people are saying, hey, I'm gonna think about it, or like, hey, listen, man, like especially with the IUL, like this is your future you're talking about. Because the thing is, once you locked in, you locked in. You can lock in today, and a year later you have cancer. You already locked in. You just continue to put your contribution in.
Right.
But if you don't start it right away, like ideally speaking, if you're 25 years old, you need to be putting $250 or more into an IUL. It's that simple. 25 years old, $250 or more into an IUL. Then by 65, like, you on your way to have $1 million, and a great amount of death benefits as well.
James is nice. I'm like 500 into it. At least 500.
Minimum.
At least
250. Because if you, like, I'm just taking into consideration you 25 years old, you're making 30,000, 35,000 a year.
Right.
Listen, $250 a month, that's to your future self.
Yeah.
Because whether you want it or not, you want to do something today, your future self will thank you for. That's a beautiful quote. One of my favorite quotes. I don't want to mispronounce the person's name. I forget who said it, but you want to do something today that your future self will thank you for. So what I always tell people is look at your surroundings. And most people in our community, but anyway, whoever you are, look at your surroundings. And if you see
Mhm.
somebody in their 50s, one day you're gonna be in your 50s as well. Is that where you want to be? If not, then what are you gonna do about it? The
Yeah.
IUL is a great way to start. Because if that person who's under 50 actually knew about the IUL back then, or a similar vehicle, then guess what? They put that 250 in, they'll be a much better and much better position right now.
Right.
And what if you say, you know what, I don't want to be thinking about my future right now. I don't want to be thinking about retirement. Great. If you're 25 years old, I'm pretty sure probably 8 out of 10 of you want to own a house. So wouldn't it make sense for you to start putting something into an IUL that's gaining, compound interest? And by the time 30, 35, 30, whatever you want to, the goal is you just access that money in a form of down payment.
Absolutely.
It's a no-brainer. It's a no-brainer. So
Yeah.
25 years old, at least $250 a month minimum into an IUL.
Yeah, that's money, man. That's good bread. Like, what's that? Like 3 bands a year or something?
Yeah, just about.
Yeah, 3
If
bands
you're
a
making
year.
35,000 a year, you take 3,000 out of that, you should at least be able to save that.
Seriously, like, man, if you
Yeah.
was looking to get a house, you can get the down payment FHA loan 3.5%, and then
Oh,
you can use, you got, say, in by 30 you wanted to get married. Boom, you got $15,000 in that policy already paid into that policy at 250. I mean, I would have increased it to 500, but at 250, at least you got 15,000. Like, hey, there's ways you can go and get down payment assistant programs, and then you have 15,000 extra in that policy. Now you can pay for your wedding ring, or certain type of things for the wedding or the honeymoon without having to come out of pocket. You use the insurance people's money, the insurance company's money, to fund whatever you need to fund. So you have the benefits. It's not like you have to use this just for retirement. No, that money is your money, and you can use it on whatever you want to use it on. And another good thing about it is it's asset protected. So if you run into lawsuits or anything with the law, they cannot, they
nope.
can't hold your money in your life insurance policy because it is not considered an asset. Like, bro, when I tell you this
It's a
like
cheat code for
instrument is a
life,
cheat code,
bro.
and it's hard because they make it extremely hard for a lot of people like us to get it in our community. One, health issues is a main factor. That's the number one thing when it comes to, if a few episodes back we covered why people would get denied, and the number one reason was
Health.
health.
Yep.
And another one, I think is number 2 or 3, it was a felony. So when you think of those two, that's our community in general. Majority of everybody has
Yep.
is bad health, and then there's felonies. So the cheat code is you already counted out of the cheat codes just being in the environment that you growing up in. So like those of you who aren't affected, you should be taking advantage of this.
Yep. Yep. It's a no-brainer.
Easily.
It's a
So
no-brainer.
all right, man. We're gonna go to the next question. So how can I access my funds in my policy? We know that it's tax free, but how do I access the money? So the easiest way to put it, um, as an investor in any type of investments, life insurance is not an investment tool. However, when you are investing your money, the number one factor when it comes to investing, a lot of people think is rate of return, but really in all actuality, it's not rate of return, it is liquidity. So liquidity is the top priority when investing your money. When times of uncertainty comes, how liquid is your money? If your money is caught up inside of a 401k or IRA or all of these different accounts that are qualified, or they don't have much, they have too many strings attached. So say you needed to access the money and you had to get hit with a penalty fee because you need to access it before 59 and a half, and then you also got hit with taxes that year. You got hit twice. So now your money's getting, hit 2 times by the government and by, the companies who are penalizing you for using that money. When you have the IUL, you are liquid. Your money is liquid. So how that works is if you needed to borrow, um, in certain type of policies, if it's structured correctly, you can borrow up to 93% of that money within 30 days. We don't recommend that, but that is a possibility. Um, you have to be very, very financially savvy to do that. Like I would not structure anybody's policy if I know that they are not, responsible enough to even take that money out and do something with it. However, if it's a business owner and I see that the statements are there, they're making their capital, they're making their money and their rate of returns on whatever they're doing, like, yeah, you structure that. But however, you have access to that money. What you do is you call your insurance agent. So whoever structured your policy, you call that agent, or you can call the insurance company yourself. If you are savvy enough yourself, you can call them. They will send you a form. You fill out that form and you get an EFT transfer, or they can send a check. They'll send that money to your account or your house within, 1 to 2 or 3 business days. So that money will be right to your mailbox or in your account whenever you put access, or you ever send, whenever you send in that sheet. So you fill out that form, boom, you get your money. They transfer that into your bank account. That's how liquid your money is. There's no fees, there's no restrictions. They're not going to run your credit, they're not going to penalize you. It's your money and it's there for you to utilize if you need it. So the insurance company is going to lend you that money, or you're going to take out a loan and you're not going to get a credit check. You're not going to get penalized, and they're going to lend you their money. Your money's going to stay in that policy, and that's how it's going to work. And then you just pay yourself back as you get the money back. You always want to pay yourself back, because what that does is that expands your borrowing opportunity. It's just like a bank. So in a bank, if you pay your loan back, they will allow you to borrow more money at the end of that loan once you pay it back. It's the same thing here. When you pay it back, your borrowing opportunity is expanded even more, and now you can borrow more money when you do pay it back. So how quick and how you can access your funds is very quick, 2 to 3 days, sometimes less. And then you just call up your agent, or you can call the insurance company, and you want to make sure that you check the box that says index loan, or get with a financial professional before doing that. Trust me.
Yep.
Like, that stuff is very complex because there's multiple loans on your policy that you probably have no clue what it is. So definitely speak with a financial professional before accessing your funds.
100%. Well explained, man. Very well detailed, simple, well explained.
For sure. Thank you. All right, next one. Our next one is what would happen to my policy if I lose my job and can't fund it anymore, or for a certain
This is a
period of
good
time?
one. This is a good one. This is a really, really good question. So this is the beautiful thing about the IUL. And we covered that earlier. We said that it's a flexible account. And I'm going to use a personal example. And I think I used it in one of the other shows already, but I might use it again. So I had a client. I have a client, still my client, during COVID. Hey, like many people, she got sit down, so she paid a policy for almost 2 years. She called me right away. She said, James, I'm worried that I'm going to lose that policy because I don't have my job anymore. And when I told her, hey, don't worry, you can actually go a few months without paying it and it'll still be active. She said, what do you mean? I said, remember I told you about the cash accumulation value? And she's like, oh yeah, I remember that. I said, okay, we're going to make a call together and I'm going to show you. So we called the insurance company, tell them about the COVID situation. She got furloughed and, hey, and come to find out she had 9 months free. like 9 months, she can go without paying the policy and it will still be active. When I tell you she was happy, she was happy.
Sure.
So what is the worst case scenario when you set up an account like that is that you can lose your income. And just because you lose your income does not mean you lose the policy. Once you actually let the company know you've been furloughed or you lost your job, they'll let you know, hey, this is how long you have. Is it 9 months, 18 months, a year, 2 years, depending on how long you already had that policy. Then from there, you can actually, relax, and until you get things back together again, and you can start putting out the exact amount of premium you actually sign up the policy for. Now, how does that affect you? The way it affects you is, well, your cash value grew a little less. So if we had project for you to have, let's just say, $20,000 within the next 7 years, now because you go about 7 months, 8 months, or a year, 18 months, you don't fund that policy because of certain circumstances, then of course it also affect the potential accumulative value you were supposed to have on there. But yeah, you don't have to worry about losing your job. You're not going to lose the policy if you do, because the policy will pay for itself from its cash accumulated value.
100%. That's the beauty of it, man. I love that factor. And honestly, I did that too. I stopped paying mine for a minute. I wasn't selling any policies at the moment. I took a step back from insurance. So like income was low, when I first got my policy, and I didn't pay it, but my policy was still active. I done caught up on it now. I done doubled down. Like, don't get it wrong now. I'm funding it heavy now.
And like doubling down.
Don't get that wrong now. Like, yeah. But that's the beauty of the IUL is, like James said, it's flexible, y'all. Like when you fall on hard times, like which happens, to the best of the best people, like you have the ability to pivot with this policy. And that is the main difference between this and a whole life policy. A whole life has level premiums, and your guarantees can get extremely messed up if you don't hit those level premiums every single year. You need to be paying the same amount of money every month, every single year to guarantee you those dividends and those payouts that they're going to guarantee you. If you don't, that can mess up your policy a certain way. And you may not get those guarantees because you don't have that flexibility in that policy, unlike the universal life, which is why they did come out with universal life over whole life, because some people needed that flexibility.
Exactly. And those, I mean, take this off the screen real quick, Julian, because, I want you to watch this and really pay attention. I'm going to cover 2 things with you about this policy. Julian mentioned something, which is about the whole life. Listen, if that's the way you want to go, that's fine. But remember, it's level. You must continue to pay that same premium. So what is the two important things people look at is liquidity, Julian said as well, and also is flexibility.
Oh yeah.
It's flexibility, because if I'm paying $700, $800 a month into a whole life policy, and God forbid something happen, my income decrease. So you got to really pay attention to that. So also, just to go back a little step, is there was a case that the other company that we used to work with, and there was a story about a lady who actually stopped paying the IUL. She stopped paying the IUL because she got sick. She wasn't working anymore. She got sick for quite a few months, for a little while. Unfortunately, she passed away. So even though she didn't make any premium for a while into that IUL, the family still received the death benefits. So let that sink in for a minute, man. Like, it's just a no-brainer on these policies.
Term would never do that.
Say that again?
Term would never do that.
Nah, Term would never do that, man. Term would never do that.
Never.
Another strategy I was talking to Julian earlier about, it's like, hey, what if somebody say, hey, can I use my income and run it through an IUL and then get paid every month from that? It's possible. However, I wouldn't recommend it until or unless you're making 3 to 4 times of your living expenses, at least for the first year.
Mm-hmm.
After the first year, how does that happen? So let me give you an example. Say you're making $10,000 a month, and you say, you know what, James, I heard you talk about I can actually run my income through an IUL and then pay taxes. Can I run my income through an IUL and then pay my bills? Yes, you can do that as well.
Mm-hmm.
But you got to be careful because it takes a lot of discipline. It takes a lot of discipline to do that. But it's a great strategy. So as you're funding your IUL, and if you, let's just say you have a year of your personal income saved up and you want to actually fund an IUL to start doing that, that's a good idea. Where you actually put the $10,000 or maybe a little bit more, maybe 12,000 every month into that policy. And once a month, you have that policy dropping $10,000 into your account, and then you pay your bills. I'm telling you, man, it become a really cash cow right now.
Oh yeah.
It's major because you're funding $8,000 to $10,000 or $8,000 to $12,000 a month on there. But it will take some major discipline. But as I was strategizing, calculating in my head, I said, yeah, that is actually possible. But to someone who's extremely disciplined and who's actually living below their means, you know, they have to make sense. But I know we go over an hour already. I know we have quite a few more questions to go through. But geez, this conversation is so interesting.
Always good. Yeah.
A lot of great information. But hey, we did reach an hour. I don't know if you want to go over one more question, Julian, or if you want to add
Yeah, we can
anything.
cover some. I definitely wanted to go through this. You know, some things to be aware of to give y'all game, and I'm gonna put I'm gonna display it on the screen. What you want to watch out for when getting quoted IUL or any type of product, permanent product, but specifically IULs is the huge commission. They're very big on commission based when it comes to the insurance industry. And I hate to speak about it like this because I'm an agent. James is a broker. We sell policies, but the truth is the truth. People can really mess up your policy. They can mess up your money. And imagine, you saying like, oh, my nephew or my cousin, my uncle, somebody, oh, they sell life insurance. Let me go to him. And they structure the policy and they put it in favor of themselves. And when I mean that is IUL is supposed to be structured properly by shrinking the amount of death benefit, getting the least amount of death benefit as possible in that policy that the IRS will allow, and then maximizing the cash value. So when you have insurance agents who don't know what they're doing, what they do is they look at it like, okay, I'm about to line my pockets up right now, and if this person's about to put $500 to $1,000 in this policy, I'm gonna probably get paid $12,000. That's how they're looking at it.
Yep.
Because in the insurance industry, you get paid 12 months in advance. So if that is $1,000 a month, and you're at 100% commission structure, you're putting in $1,000 a month. What's 1,000 times 12? That's $12,000. If you're getting 100% commission, they pay you about 90% up front, maybe, or 80. So you're making about $8, $9, $10, $11,000 on that policy. And if that was a family member and they didn't know what they were doing, their policy would look like this, where you see a value. This is your annual premium where you're paying $2,400 a year, and then your value is zero, meaning your surrender value. So if your surrender value is at zero for all of these years, that policy is structured incorrectly, and it is a disaster waiting to happen. It's full of fees. The cost of insurance is extremely high. Your death benefit is maximized. And honestly, like, I'm sure there are agents who are still doing this out there.
Yep.
Like it is real. So beware of this. If you are seeing this in a policy, this is something you want to watch out for. And this one over here, it still has 3 years with no value in it. So think about it. You put $2,400 and you have no cash value in that policy yet, no surrender value. Your policy, you're not able to borrow from this policy until year 4. And then at, year 4, you're at 2,400 times 4. That's $9,600. You only can borrow $365 from that policy. That is incorrectly structured.
Yep.
You're losing, like, most of your money is going to the cost of insurance. And this is where, a lot of people have destroyed this policy, and this is where the negative, reviews come in. This is why Dave Ramsey could talk what he talks. This is why people could get on and say IUL is a scam. This is why whole life people who sell whole life, this is why they can talk bad about IULs, and it's simply because of this right here. And what you're seeing right here, and how people are structuring these policies. And hey, the insurance guy, whoever it is, they lining their pockets up. Imagine if that's your cousin. Imagine if that's your brother. Imagine if that's somebody and they did this to your money. And when you went to try to go access the money, you didn't have as much money as you put into that policy. That you're talking about ruining relationships, family members ruining relationships. So be sure, if you're going to get this policy, you want to be sure you're with the agent who can structure the policy properly. Somebody who can explain, explain the benefits of it, but explain the details, the tax codes, the surrender value, how to borrow from your policy. People who can explain the policy and structure it correctly are the people you should be talking with.
Yep.
And we're talking right now. You know what I'm saying? Like, we your guys, like, we can do this. We do this, man. We've been doing it for years now. And it took time to learn this, though, because we didn't come into the game learning this. It's trial and error.
Trial and error. And coming to the game is who's teaching you, to tell you the truth, Julian, because whoever is teaching you, that's what's gonna trickle down. So these things happen every day, every single day. And as well, that also when you're getting an IUL, you have to be able to, for it to make a lot of sense, max funding the IUL as well.
Oh yeah.
Max funding the IUL. But let me tell you how, recently, I think a month and a half ago, I set up a child policy. It was an IUL. It was a beautiful product, man. I'm like, man, I wish my mama started this for me when I was a baby, 5 years old. But anyway, the mom came to my office. She said, hey, I heard about the IUL. So we sat down, we talked, gave her an illustration. She looked at it. She took it home, and then we got another appointment. And she said, you know what? I want to start this. I want to start this. So she started this, Julian, with 10 grand for the daughter.
Beautiful.
10 grand. Did you know my commission wasn't even $1,000? Because it was for a child. I remember that one. I told you that, right?
Whoa.
I was like, whoa. So think about it.
That's the integrity there, man. You got
you gotta do right by the people. You gotta do right by the people. And I had an opportunity to make a lot of money on there.
At least $8,000 to $9,000 to $10,000.
At least. But guess what? For what you just said, really, another agent see this and they're gonna be like, oh, what? Who give this to you? Yeah. Oh, my really good friend James. He say he's the king of insurance. The king of insurance did this to you?
Yeah.
Let me explain something to you. And then they go over the policy together. Now I'm like the trash of insurance.
Yeah.
So understanding people come first, man. When it comes to setting up these policies, I had to learn. So what Julian and I, what we're talking about right now is one of the key component of the industry, and is one of the key component why you see a lot of people could be in the internet talking negative about the IUL, simply because agency they pocket first, because you can make a lot of money in the industry, a lot of money. So that's just to tell you, man, people first. We're gonna take care of you first. You come first. So
you got to. It's better that way though. Long term wise, relationship wise, you build that trust when I'm not gonna line my pockets up, because it's easy. I could easily line my pockets up like, hey, I need $10,000 right now, man. I'm gonna do it. boom, boom, boom. And I'm telling y'all, it's a very lucrative industry. So if you structure it incorrectly, you will get paid good as an agent. But again, like James said, that next agent who comes around is like, what is this? Who structured this? Boom. Now your credibility is shot. Everything is shot years down the line. It may be a year, it may be 2 years. So you never know. It's always that agent coming behind you to check up on what you have done. So that is how improper policy will look. So now if I show you this one, this is a bit more stronger because it's a higher amount put in, but it shows a properly structured policy. So in year one, if you look at year one, it shows you with $50,000, you see there's a premium charge. There's a cost of insurance. You can see the cost of insurance is $226 a year. That's how little the amount of insurance is in this policy at first. It's an increase in death benefit for maximum cash value, but then it levels out in the latter years. So once it gets a little bit older, the death benefit is going to level out, meaning it's not going to increase anymore. But it was increasing for that max cash value. But if you did 226, that's about $18.83 a month for the cost of insurance. And then you have the policy charges and the premium charges, which are always going to be in the insurance policies for the first 10 years. That's how the insurance company makes their money. That's how they pay their employees, their payroll. They get all of their expenses out in the first 10 years. So if your cost of insurance is low, remember, that's how you maximize your policy. So here you can see interested credited is about 2,000 at a 5% rate. This is very, very conservative, but we're looking at surrender value in the first year at $46,671. We put in 50, we can get out that much after all of our fees and cost of insurance is out. So that surrender value, remember that last policy we showed, boom, those surrender values are at 0 the first 3 years, the first 9 years. Imagine how much money this insurance agent made, bro. Like, bro, they probably made like at least 5 to 10 bands, at least. And then they probably made a little bit less. But here in this policy, somebody putting in $50K annually, I'm not gonna get paid that much.
Because it's structured the proper way.
It may be more than $1,000, but I'm not gonna get paid as much as $50,000 was being put in it. Is
right.
That's just not how it works when you structure it correctly. So it's about the integrity, man, and and building that trust within the people. And that's why we created the Agent and Broker podcast, man. We wanted to build and establish and reestablish trust between insurance and the people, and helping our people get insured and get their finances in order, man, so we can combat this so-called wealth gap that they have in place. But eventually, as years go on, as people learn more about this and they know that they can leave their family wealth behind by just paying money right now, shoot, man, we're gonna be in a better position, honestly.
Yep. That's the cheat code, man. This policy is a big cheat code, for you while you're living, and also the next generation we're gonna leave behind, because everything blossom tax free. So even after you're getting your retirement income from this policy, your loved one will still receive a nice chunk of change when you pass away, tax free income. And what you need to do is set up a trust. I don't want to go through the whole thing, but what you need to do is set up a trust and have that money delegate the proper way. So whoever is next in line to receive that money, they need to get an IUL, and also set up themselves the same way you set up yourself. And that's what they talk about, creating generational wealth.
Literally.
Because you take care of yourself, you take care of the other people, make sure you have a system set up. You set it up through a trust, and let me tell you, just keep going and going and going and going.
That's it.
Yes, sir.
That's it, man. That's honestly, like, that's, we can get into more about these IULs, man. We'll have more upcoming episodes for sure. Digging more, hopefully more people ask more questions going forward. And we'll get into like indexing and the different strategies, what we can do in the IUL, because this product, honestly, it can take episodes to really explain it. Like
Yeah.
multiple episodes to really explain it. We haven't even covered a whole portion, what is called indexing, which is an entire financial strategy that many people don't know about. They think of index funds, but it's not index funds. Indexing is through the insurance company. And properly structured IULs can really gain a lot of interest if you have the money. Compound interest works in your favor when you have money in it. So if you have a lot of money in your accounts, compound interest is your best friend.
Yep.
Time and
100%.
compound interest, like you getting a lot of money, man. Like there's people out here making like $300,000 gains in their policy because they have over 800,000 in it. Like, and that was like during the pandemic, there were people who made 60% returns in their IULs. Like this is stuff that is out here that you can get online and see for yourself. So it's not like we're capping to anything. Like these case studies are out here, y'all. Like, and I can't wait till like 5 to 10 years when James and I will, we've structured as many IULs as possible, and we're looking at the index and crediting strategies where, we're trying to get the most returns, and people are going to come back and be happy. Like, whoa, you guys were right. When our policies are averaging 7, 8, 9%. Dow Bar says that the average S&P return is 4% over the amount of 30 plus years. There's the 4% rule in the financial services industry. You got 4% required minimum distributions. It's 4% of your earnings. After all of that time you done save in your 401k, you only can take out 4%. That's what they require you, or that's what they suggest you take out. A financial advisor will tell you to take out only 4%. So you don't outlive your money.
Can you really live in 4%, man? Like, and 9 out of 10, I'll say maybe 8 out of 10 people, you don't even have that much money in the 401k.
The average man, they're telling the average people this flawed financial advice, and it ain't gonna hit them until it happens, and then it's like they're gonna be calling Julian and James, like, guys, what do I do? Like, hey, hopefully you ain't had no health problems by then. So
right, because if you do, I mean,
for you.
there's nothing we can do really, man. And just to put a little bit cherry on top of the 401k, understanding the 401k, one of the main reasons it was created is because after the recession, not enough people was getting back into the stock market. So now they create that system where you as the worker, they take a percentage of your income so they can get the stock back to roll again. So 401k was never meant to be a retirement vehicle. Pensions used to be the retirement vehicle people retire on, because with the pension, after you leave your employer, then you get that money coming after retirement. So you get a pension until you die. When they give you a 401k, probably one of the worst things that happened in the financial realm, if you're comparing it to what used to exist, which is the pension, man, they really mess us up with that 401k. But you talk to the traditional people, oh my God, my job was for 401k, I'm good, man.
I'll stay away from them. I don't even put any money in it. I don't want it.
Only if you understood that statement you made. Oh man, my job was for 401k, I'm good. Yeah, okay. Yeah.
The only one I'll even consider, even though I would never do it, is a Roth 401k. That's it. Like,
probably.
401ks are disasters waiting to happen. You're procrastinating paying the government, bro. Like,
pretty much. You literally tell the government, like, hey, listen,
procrastinating.
I'm gonna go 30 years in this job, 40 years in this job. I ain't gonna pay you taxes yet. So when I retire, I'll start paying you taxes.
That's like a legal scam, bro. Like they sit here and tell you a 401k, y'all, is a legal scam. They will tell you that, oh, this employer is gonna match up to this amount of money. But when it's time to go into retirement, imagine you paying all of that money back that they matched in taxes, bro. It's the truth. You're gonna be paying that back in taxes. So regardless of how much they've matched, they matched and you made $400,000, you're gonna pay that right back to the government. So it's like, why even take that bait when you can come over here and do the same thing that the banks are doing? Boom, putting it inside of a tax-free vehicle. Some people go the Roth IRA route, but I'm like, why not take it a step further? You got the Roth IRA benefits plus extra benefits on the life insurance, plus the liquidity. Like, you can borrow against your Roth IRA too, but you can only put up to $6,000 in the Roth IRA. I can put $6,000 a month in the IUL if I wanted to.
Yep.
I could put 7,000 a month. I can put 100,000 a month. I could put $1 million a month if I had the money. Like, there's no cap to how much you can put into this policy. And, that is one thing that we covered tonight. So, hopefully y'all learned a lot. We brought some, covered some good questions. We can always do another episode on this. We definitely will. We'll go into indexing. We'll go into more in depth on the policies, designs, what to look for, because we want to be as transparent as possible with the people.
Yep.
And, let people know that we are here to help you, in the best way. So again, you can go to agentandbroker.com, fill out our form. If you want to request a quote, you can do that as well. Click the link in our bio on Instagram. You can go and create your own quote as well. So that's another cool tool that we have, where you can go in there and design your own quote, like design your own policy. So now, if you had any questions, our number's in there, our email, reach out to us. If you don't, we'll reach out to you if you were interested in getting a policy. So guys, this is, it's crucial. You got to take action immediately. You never know. You never know.
And the right place to be is www.theagentandbroker.com. We're going to make sure you understand the process, because in every decision we do and everything we do, you come first. Your goals come first. And we need to educate you, make sure you understand every single details about this vehicle. So we look forward to helping you guys. We love you. Once again, thank you for all the downloads. Make sure you share this. If you see great value, just make sure you turn in every Monday at 9 p.m. Julian and I, we here. Sometimes we have guest speakers and, or we just go ahead and tackle the subject like we did today. So,
Absolutely.
hey,
tap
that's
in,
what
y'all.
we do.
Keep pushing. Keep on pushing, like Patrick said, man.
Keep on pushing.
We're going to keep on pushing. Y'all keep on helping us out. Like, comment, share, subscribe. All of the content, share it with your friends, your family, and encourage people to get life insurance and make that move, y'all. We're excited. So thank y'all for another night and another episode of the Agent and Broker podcast. I'm your co-host Julian,
and I'm James. Deuces,
and we out.
The agent and the broker put you on the right path. And if it ain't adding up, then do the right math. And when you wanna come up, some might laugh, but them be the types to be the overnight staff. Always be a worker, we tryna be some owners. Sometimes might strike out, sometimes we hitting homers. But one thing's for sure, when the money gets uncovered, hit the agent and the broker. Say thank you to my brothers.